There is no better time to talk about cash to accrual for accounts payable and expenses. Now we're going to get to some examples later. We're going to be talking about hot DJ enterprises, so strap in, right? This is going to be a great little session. So what's the agenda for this video? Well, first off, we're going to talk about the cash to accrual overview for accounts payable and expenses. We're going to look at the journal entries and how accounts payable and expenses are impacted. Then we're going to talk about the balance sheet approach and how to use it to solve for cash to accrual. And then we're going to rip through a couple examples. So when we think about accounts payable and expenses, what's the difference between the cash basis and accrual basis? Well, on the cash basis, we would recognize the expense when invoices are paid in cash by the company. And under the accrual basis, we're going to recognize those expenses when the service is performed by the company and we receive the invoice from that company. So why is there a big difference between the cash basis and accrual basis when it comes to accounts payable and expenses? Well, because when we receive the invoice, it may not be due for 60 days, right? So if we're looking at the example here, we might receive the invoice on March 15th, year one. And if the invoice says it's due in 60 days, well, any smart company would say, okay, unless I'm getting a huge discount, I'm going to wait the full 60 days and I'm going to pay off that invoice on May 15th. So on the accrual basis, we're going to recognize the expense when we receive that invoice. And then on the cash basis, we're only going to recognize that expense when we actually pay that invoice on May 15th. So under the cash to accrual, right, there's a big lag here. And that is why it's important to understand the fundamental difference between cash and accrual when it comes to invoice expenses. So it's extremely important that you understand that certain types of expenses that a company incurs, they don't have an invoice. But other types, especially when the expense is with a third-party supplier or vendor, they're likely going to send us an invoice, and that's going to lay out the terms, all the things they need to do to recognize revenue on their end, and it allows us to recognize the expense on our end. So what are some types of expenses that we would expect to receive an invoice for? Well, anytime we purchase materials, right, and that's typically related to inventory. How about utility expense or consulting services like accounting and legal? How about travel expenses, airfare, hotels, meals, and entertainment? How about telephone expenses? Or really just IT service providers, right? If we have a Salesforce license, we're going to receive an invoice for that. If we have, accounting software, again, from QuickBooks, they're going to send us an invoice. So those are the types of expenses we would expect to receive an invoice for. So now let's shift back into what actually impacts the accounts payable balance on the balance sheet. And we're going to talk about what increases it and what decreases it. So accounts payable is going to be increased when we receive an invoice from a vendor or supplier. And they're saying, okay, you owe us this amount. You don't have to pay us for 30 or 60 days, but the company would record that invoice into their accounting system. And it says, okay, we're going to have to pay this off in 30 or 60 days. Let's go ahead and recognize the expense and we'll recognize it in our payable balance. And then only then would it be decreased when we actually pay off that invoice by sending the supplier or vendor a cash or check. So let's go ahead and look at the journal entries, right? And we'll talk about the two types of journal entries that will increase accounts payable, and then there's going to be the one type that decreases it. So when we think about what increases accounts payable, again, think about the invoice expense types. Well, when we purchase raw materials or finished goods, that is going to be capitalized into inventory. So as we can see, invoice for purchased materials, well, the debit there is not an expense account, it's actually inventory because again, we're capitalizing those purchased materials into inventory. And as we learned in our cash to accrual for inventory, that only gets expensed through cost of goods sold when the unit is actually sold. So in this case too, right, we would credit accounts payable. And again, crediting accounts payable is increasing the liability. And then if the expense was more of something like utilities, consulting, travel, telephone, or IT service, right? We call those operating expenses, or also known as period expenses. That debit will, instead of being to a balance sheet account, is going to be to an operating expense account. And then again, the credit, that would still be to accounts payable because we're recording the invoice and increasing accounts payable. So in both of those situations, again, we're increasing the accounts payable balance because we received an invoice, but we're not yet paying. So now the time has come when we're actually paying that invoice. And this is when we would debit accounts payable because again, a debit decreases the liability, removes it. Well, the offset there is going to be cash because we're actually paying cash to the supplier. So those are the 3 journal entries related to accounts payable that you really need to understand. So now that we understand what increases accounts payable and what decreases accounts payable, as well as the associated journal entries, now we're ready to talk about the balance sheet approach and the accounts payable roll forward. So this is the roll forward that you're always going to use. It's always going to start with beginning accounts payable. And then again, what increases it? Well, invoices are received. And then what decreases it? Well, invoices are paid. And then what we're left with is ending accounts payable. So we'll go through 2 examples. The first one's going to be cash to accrual, and that's where we're going to be looking for the amount of expense recorded on an accrual basis. And then we're going to flip it around and go from accrual to cash. And we're going to figure out how much cash was paid to suppliers. And you'll see that this accounts payable roll forward does not change. So in our first example here, we have Hot DJ Enterprises. They're blasting the beats. They have the following financial information during year 1. So in this question, right, they give us beginning accounts payable, that's 500, so plug it into the roll forward. Then they tell us that ending accounts payable is 250, so we'll plug that in. And then it tells us invoices paid in cash was 750. So that's gonna be a negative 750. So now we need to figure out, well, what amount of invoices were received, right? Because that's gonna be the accrual amount, or what we should expect for an expense amount under the accrual basis. So if we need to solve for invoices received, well, the easiest way to do this is take the 250 ending accounts payable. And since that's a negative 750, right, when we actually pay those invoices, we're just going to subtract negative 750, which takes us up to $1,000. And if we had beginning accounts payable and we had to get to 1,000, then we know that invoices received was $500. So that's going to be the amount of expense recorded on an accrual basis in year 1 for this question. So now we'll flip it around. We're going from accrual to cash, which means we're going to figure out how much cash the company actually paid the vendors and suppliers in year 1. And again, we're still with Hot DJ Enterprises. They're still blasting the beats. So beginning and ending accounts payable balances, those are the same. Now, since we're going from accrual to cash, in this case, they say the invoices received were $1,500. And again, remember that increases accounts payable. So if we're looking at our roll forward, we have beginning accounts payable, that's 500, plus invoices received, that's 1,500. That means we're all the way up to $2,000. And then if our ending balance is 250 and we're at 2,000, that means that the company paid in cash to vendors and suppliers $1,750. So that's going to be the amount of cash paid to vendors. So now that we've walked through what cash to accrual is and how it's different for accounts payable, we've talked about what increases accounts payable and what decreases it. We've gone through the journal entries, and now we've gone through 2 examples. You're ready to crush this on the exam. If you have any questions, please reach out.